Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, and Ben Kingsley, chair of Property Investors Council of Australia and the 2014 and 2015 Property Investment Advisors of the Year.
All right, folks, you're on the Property Couch. Each week, Ben and I bring you the insider's guide to property finance and money management. Hello, mate.
Hello, mate. How are you?
Very, very good, thank you. Hey, we are fast approaching 1,005. Well, actually, not 5-star reviews, just reviews.
Reviews. It's very exciting.
On iTunes, because we do have 1-star reviews, and people are welcome to give us 1-star reviews.
Don't know what these sheep are following. I think was one of them.
Yeah, we certainly haven't got a monopoly on fire. But hey, there was one here, Ben. I wanted to read it out.
Sure.
It was from Jennifer, right? Jennifer's born in 1978, so she understands you and me. Mm-hmm. Born in the 70s. Obviously, you wouldn't understand.
It's good to be light-hearted because we're getting serious on today.
We are getting serious today.
So
did you notice I went straight into a light-hearted moment?
Right, there we go. Just letting you know, big
quickly,
warning.
I've just finished binge listening to all 191 episodes. I listened to them in the car on the way to and from work. Not only has my road rage reduced, Ben,
Rightio,
but my knowledge has increased tenfold. We have implemented many systems and have shared your podcast with anyone that will listen. We can see that our future retirement will be a lot brighter with you boys in our lives. Thanks again for your hard work and putting the hard work together week after week. My only criticism is that Ben follows Collingwood.
Oh.
No, I ad-libbed that. My only criticism
is this person?
Is what can I listen to now when I only have one podcast with you boys a week? First world problems. Right. Isn't that
lovely?
Who was
that from?
That was from Jennifer, born in 1978, Ben.
Jennifer? Jennifer's doing road rage.
Just the lead over. Yeah.
Jennifer, road rage. Wow. Okay.
Hey, but I thought we are a couple of things. We are at 3.85 million downloads, Ben.
Yes.
We are at 195 episodes today.
195 episodes. Yes.
And
got it.
We've had 994. Thanks for repeating that for me.
All right.
You were going to correct me and then
realised
I was
thinking
right.
you were going 994.
Don't worry, I saw what was going on there.
Got it.
And 3.85 million downloads.
Yes.
994 ratings, 195. So there's a few milestones there, Ben.
Yep.
We're almost at 1,000 ratings.
Yep.
We're almost at 4 million downloads.
Yep.
Almost at 200 episodes.
Like it.
So what I want to say is, if anyone has enjoyed our podcast from the beginning,
yes,
and they want to be one of the 6 people, Ben.
6
people will get us over the line.
Oh.
6 people.
That's true.
I was panicked.
Worked.
Where do you think I was going to go, Iris, with that?
We didn't know. We don't know where you're going today.
We're just asking for...
I'm just very focused on the big topic today.
I know you were very serious as you walked in the room, because we've got a serious topic, which is why I'm keeping it light at the beginning, because we'll deep dive in a second. But if anyone on the podcast wants to put their hands up to be one of those 6, Ben, we would super appreciate that.
Yep.
To tip us over the line.
Tip us over the line.
Now, our supreme hope is that it's not 6 1-star. But if that's the case, that's fine.
It's okay. It is what it is.
If you feel inclined to nudge it up the scale a bit.
Smile with your 1-star that you give us, that's terrific. Yeah. No problem with that.
But just if you wouldn't mind helping us chase the 1,000 ratings, that would be super.
Very cool. First Australian business podcast to ever hit 1,000 reviews.
Ooh, just a little bit of FYI for you. Was that an early, did you know?
Maybe.
Oh, maybe. Okay. And the other thing too, Ben, is as we're going to celebrate on our 200th episode, we've got some, we're not going to reveal too much, but we're very excited about our 200th episode.
Yes.
So if anyone wants to go onto SpeakPipe, Ben, thepropertycouch.com.au.
Yes.
They go to SpeakPipe, there's a little widget on the right.
Yep.
And if you want to leave us a message, what we would dearly love to know from you is, what is the number one takeaway you have got from listening to our podcast for those people who've listened all the way through.
Yep.
And we'd love to feature that in an upcoming episode. But what's the number one? If you want to give us 2 or 3, no problem, but just one.
Yep.
One takeaway, so that A, we can see we're on track, B, we can make sure that we put it...
And we'll play them.
We'll play them.
We'll play them.
So SpeakPipe
on
message...
our 200th episode.
Thepropertycouch.com.au. Hey, my Mindset Minute, Ben, is a segue into the serious nature
of today's podcast.
Potty.
On today's potty.
Potty.
All right. You know. Well, in the AFL they talk about, let's go to the presser, like the press conference.
Yeah.
So, I like Australians. We just like to abbreviate things.
Yeah. And we're straight out of having young children, so we swap one potty to another. Hey, and you want to give us a little... the topic of today's episode was yours, mate. So
bubble, property bubble.
Oh, we're in a property bubble.
Or property balloon.
Oh.
Oh, question mark.
Do tell. All right, so I'm going to segue into property bubble versus property balloon.
Sounds good.
Oh, I like it. And what does that mean, Ben?
Yes.
Exactly. So today, it's a quote from Corrie ten Boom, right?
Right.
Worrying doesn't empty tomorrow of its sorrow. It empties today of its strength, Ben.
Oh, Confucius say.
You like that?
Yeah.
Did that one for you.
That's good. So,
Worrying
anxiety.
doesn't empty tomorrow of its sorrow. It empties today of its strength. And the good thing is that I've got a framework that I've been working through with Jamin, who, for those of you who don't know, is a personal development coach.
Yes.
And it really drills down on that, right? So it helps people unpack. So it's good stuff. If you haven't listened to that episode, go back and have a little listen. But worrying doesn't empty tomorrow of its sorrow. It empties today of its strength. So what is the state of the Australian property market? And Ben, on the 2nd of June,
Yes.
2016,
Yes.
episode number 66, got
Ooh.
frowning over there.
Yep.
We did an episode on winter is coming and the air will be colder up high. I was see. Hey, you like that? You might have heard
nice.
that side, folks.
Nice.
So Ben, that was over 2 years ago. We've been prepping our community for this.
Yes.
So that was the segue for today. But
And
what
it's
we're going to
playing
talk
out.
what we're going to talk about today, how did the last boom materialise? We're going to talk about how is the correction playing out, Ben?
Yes.
On the demand side and on the supply side.
Correct.
We're going to talk about the big switch.
Ooh.
We're going to talk about some minor issues. We're going to talk about some headwinds, Ben. We're going to talk about a potential solution. And then we're going to summarise with some takeaways. So we've got a fair bit to get through.
We have a lot to get through, so serious hat on, and away we go. So, well, where did this context of this podcast come from? It's just that there's more and more evidence being mounted, and normally most economists don't have a good sense of the property market, right? They have a sense of other financial instruments, but they don't necessarily have a good sense of what real direct property looks like in terms of that. Now, I would argue that, been doing this now for many, many years. In fact, this is my 6th downturn. I went back and had a look in terms of being an investor. This is the 6th cycle that I've gone through. And I will say that some economists are getting better. In the last 5 years, their commentary has been a little bit better. They've moved away from macro commentary down into sort of saying that there's markets within markets. It's good to see people like that. I think even people who aren't economists, like Alan Kohler, often refers to that, which I think is good. But it's important to understand we are going up into the clouds today, taking a 30,000 foot view of the marketplace, with a reminder for our listeners, and we'll circle back to this at the end of the podcast, that there are still markets within markets. It's important to understand that. So, where do we want to start? Well, the trigger for today's podcast came from the weekend's auction clearance rates, which showed us that we are now below 50% on clearance rates. Now that is, so to give you an idea in terms of what our data suggests, that we have a balanced market when clearance rates sit between 58 and around 63, 64% on average. Under that you have a buyer's market, and above that you have a seller's market, which means that on occasion, if you get into consistent clearance rates higher than that level, you're more likely to see growth in that suburb than not. Now, it's not the only measure. We use lots of different measures for measuring supply and demand, but auction clearance rates is the best real-time analysis that we have in terms of the market. Only for Melbourne and Sydney. Please do not use it for any other market because it's statistically not reliable because there's not enough auctions that happen in those other markets. So you are wasting your time if you read anything into auction clearance rates in Brisbane, Adelaide, Canberra or Perth. Now there might be some correlation, but it's not as
Brisbane's
reliable.
rose to 50% on reasonable volumes of around 150, Ben. So
Yeah, it's getting up there. There's more auctions happening in that market, but it's an immature auction market. So you're not going to see that as being a good indicator of that. Now, what have we said all along? Property prices move based on supply and demand variables. Okay, so we talked about in previous podcasts, many previous calls, including when winter is coming, if my memory serves me correct, because it was 2 years ago.
It's over 2 years ago.
You will see,
2.5 years ago.
A spike in supply. Okay, so if people were trying to time the market, we're seeing this late entry of stock coming on. We're also seeing a building boom finishing it's the end of the top of its cycle. So we are seeing property stay on the market for longer. Okay, so it's definitely meant that we've got more supply, more listings than we've had for a long time before, generally speaking. Okay, so that is a big story here that we're trying to unpack. So before we talk about what's coming, let's go back and talk about how do we get to this last boom? What were the reasons why we got to this boom? So those of you who are new to the podcast can get a sense of the story that we've been trying to tell for the last couple of hundred episodes. So firstly, Bryce, when you have historically low interest rates, and we are talking about record levels of low interest rates that we've had, and when you combine that with people's income, you get greater borrowing power.
Because we've talked about it a bit, Ben, haven't we? We've had this decrease in organic expenses in the household from the heights of the 90s when we had the recession we had to have. It's been now that curve is driven down as low as it's got. So your expenses were organically less and less, and at the same time we've now got opportunities for households to have 2 full-time professional incomes. So at the same time as organic expenses dropping, you had organic cash flow increasing, and the combined two really comes into increasing borrowing power. And when you've got increasing borrowing power, I mean, it's not rocket science to see that that's had an impact on the property market.
Bryce, let's run a scenario. And this scenario would be playing out hundreds, if not thousands of times every month across Australia. I'm a first home buyer, Bryce, and you're my broker, and I'm coming to you to sit down to work out what I can afford. Okay. Now, I've done my numbers with my partner before coming in, and I'm thinking that I've got about $500,000 to spend. And that's because I've done my numbers in terms of, say, borrowing $450,000, and I've looked at the repayments, and I think that's about what my budget or household can afford. Okay. So I come to you with a bit of an idea because I've used some calculators, and I'm more educated than I was 5 or 10 years ago in this space because there's so much more content in it.
Now, Ben, I've had a look at your details, and I know your comfort capacity is actually 500,000, but your actual borrowing capacity is 600,000.
Oh, well, that's good information to know, Bryce. And how would that come about? Because you've got lots of different lenders of which to choose from. So if I've gone to one bank, they may only have a cap on what they can borrow. So their assessment calculators and their credit risk is usually the same for each loans that they offer. There might be a little bit of tweaking for fixed rate loans to get a little bit more out of the rock, but ultimately that's what it is. But you've given me a plethora of opportunity, haven't you, Bryce? And also, as my broker, what you're more likely to also say is, why don't we get a pre-approval for $550? Now, the reason I'm doing that is because my experience suggests that when you go on to the real estate websites and you see price offers of around a certain figure, more often than not, those prices are probably underquoted in terms of where it's going to land.
Surely not.
They are, Bryce. Just like if I was going into a car dealership and I saw a standard model of a car, but over in the corner was the sports package, I would probably justify to myself, because of my human nature, that the sports package represents better value for me, so I'm going to upgrade to that. And that's usually what's happened, because when you go out and you start knocking on doors and inspecting properties and so forth, you do say, that extra, with that extra $50,000, we might be able to have a theatre room. We might be able to have an outdoor alfresco area. We might be able to have an extra bedroom. So all of a sudden, the psychology, the financial behaviour of the borrower goes to, well, if it's available, why don't we take it? Let's go back and have a look at our numbers, and we might adjust some of our discretionary spending to get to that point. I've been doing broking for over 10 years, and I can tell you that's exactly what happens, right? So the broker, in their wisdom, is sort of saying, well, let's not get a pre-approval for 500, let's get a pre-approval for 550 in the event that you want to stretch yourself, knowing fair well that the vast majority of people are going to do that.
Now, Ben, and back in from 2012 onwards, the way that you were assessed allowed you to get more borrowing capacity as well, because instead of having an assessment rate which is above the interest rate, they were able to do existing loans at their existing interest rate, which allows you to have more surplus, which allows you to service bigger loans, which allowed you to get more. So
100%.
The environment encouraged people to get bigger borrowing capacities, which encouraged them to get bigger loans, which encouraged them to ultimately push pressure on prices.
Correct. And so when you're talking about not only owner-occupier and upgraders, so when you've got low interest rate, upgraders are also thinking, well, this is our opportunity to move into that better marketplace, especially if our prices are going up. So historically low interest rates are manufactured through monetary policy, and it happens all around the world, and obviously post GFC, and you've heard me talk about this. The reason why they dropped monetary policy so much was to put a base under asset values. Because if the valuation of assets, not only houses, but all types of assets, was to collapse, your whole monetary system implodes.
It's cactus.
It's cactus, right? It's completely done. So this was a measured move by our reserve governors and boards and lending authorities all around the world to maintain an asset price. The consequences of it have been, however, that when you give people cheaper money, you can potentially overshoot it, right? And we were talking about winter is coming with this level of over-exuberance, this FOMO, this fear of missing out. And so we have seen markets that we would traditionally say wouldn't grow so quickly over a long, long period of time have grown sharply purely based on this FOMO and the ripple effect of those valuations moving from the sort of the inner city areas to the outer areas. So when you've got greater borrowing power, when you've got a human need, and it's an emotional need, and just remember, smart property investors buy with their heads, right? Not their hearts, but owner-occupiers who represent 70% of the marketplace, they do buy with their hearts.
Practical, emotional.
Correct.
Yep.
All of the things are moving into that. So in addition to that, we also saw other ways in which borrowers were able to massage their money. And the number one thing that we saw that has been a trend up until the regulator stepped in was the use of offset accounts, an Australian invention and a wonderful idea, and we are big advocates of the offset for those people who understand money management through our Money Smart system. And what you're able to do if you've got an offset is you would park your surplus cash in the offset account next to the mortgage. Now, that meant that if you were paying interest-only repayments, it didn't matter.
It was doing exactly the same as a principal and interest repayment.
Every night. It was basically reducing the principal and charging the interest against that principal. So all of a sudden, people were getting smarter at managing their money.
So as a result, it means that they could free up more cash flow.
Correct.
Which means that they could borrow more.
Correct. And so for investors, it was a light bulb moment. Okay. And for our clients who we taught them this strategy, fantastic opportunity for them to put their money to work harder for them than actually paying off their debt.
Because isn't that a good point that you raised, Ben? Because it wasn't that long ago when you talk to a client and say, we think that you should consider making your principal place of residence mortgage interest only, not principal, not principal and interest. And they have that sort of look in their eyes.
Wait a minute, I want to pay this debt off.
Whereas here we are in 2018, that's now part of the vernacular in investment circles, and it's now, there's no stretch to consider that. Yeah, I'll go interest only as long as I'm putting the money in 100% offset. I'm fine, because it's doing exactly the same thing, but it allows you to free up cash flow. It allows you to still, if you've got the discipline to do what you're doing in principal and interest, but if an emergency comes, or you want to go on a bigger holiday, or you want to free up some cash flow to buy an investment property, it allows you to do it.
And more people learnt this secret from the content, like podcasts like ours, and also some of the more investment savvy mortgage brokers got on to this message, right? So that had led to a spike in demand through investors. But what it also did was it caused a danger in the first homeowner space, Bryce. So when we're talking about that, we were talking about people who, remember my case before where first home buyers were coming to see you, and our numbers don't quite work. Because I come back to you now, Bryce, and say, well, you said 600. So can we go 600, right? And the broker might be going, well, you can, effectively the bank will lend that to you.
But you have to go interest only.
But you might have to go interest only for those first couple of years because your budget is not allowing for that, or you might be having children, or you're going to have to furnish that property. So all of a sudden, we'll do it. We're falling in love with this property. And so we now want it, and the property market's moved, so we need to pay 600. So that was a negative consequence where we saw first home buyers using interest-only borrowings as a means by which to get into the market and being able to sustain themselves in the market. So that led to a systemic risk potentially in the system, which was identified by APRA, which we'll get to at the moment. Now, we haven't finished on what are these demand drivers, right? So we haven't finished in terms of what has also increased demand over this unique period of time where we've seen strong price growth, not record, but very, very strong price growth in both the Sydney and Melbourne markets.
Well, can I rattle a couple off?
Yeah,
so we've
sure.
got, we had foreign buyers up until when they changed the rules. We had the SMSF buyers, so it wasn't like in mass, but you had another, I guess, person entering the market, sort of creating that underpinning of price. And you had more investors than ever. You know, think back to when we were reporting on some of these podcasts only 50 episodes ago, where 60% of Sydney property purchases were investors. That's all well on a limited supply, and you've got all of this immigration coming into the country. It is just conditions for them to go on value.
That's right, because what happened was the GFC led to a mining correction, right? So the global financial crisis led to less natural resources being needed in terms of from the ground, iron ore for steel, all of the above, right? So that meant that the mining boom finished up. Government had a problem. They want full employment. You know, part of the mandate, there's 3 mandates that the RBA have in terms of them setting the monetary policy, right? The first one is around managing the currency. Okay, trying to keep the currency in order. The second one is about full employment. Okay, so making sure that they keep the economy in full employment. And the third one, probably the most fundamental one underneath of that, is the well-being. Okay, the wealth and the well-being of the people that they look after. So that's the lever that they play with in very simple terms. So we had a situation here where we were getting into all of these drivers, including the final one, immigration. Okay, so the government of the day needed to redeploy this workforce that were in the mines, and construction was going to be that story. Low interest rates, low cost of money, we needed a building boom. And that's on the back of the problem that we had on the other side, which was supply. So leading up to the sort of 2011, 12, 13, we had undersupply in a lot of our housing markets. Most notably, we couldn't supply the amount of stock that was needed to meet the demand in the Sydney market. So we're talking about, you know, 150,000 new immigrants coming in over and above what was our standard long-term
averages
immigration policy.
10 years ago.
Averages of 10 years ago.
If you think about Sydney, that has challenges geographically. It's got a harbour, it's got a hinterland, it's got a big national park at the bottom, it's got the ocean, it's got the Hawkesbury, it's not like Melbourne that's big and flat and they can expand. So they had big population centre, more people coming into it than they had room for it, not enough housing, plus all those conditions we talked about.
And a booming economy. So both of the biggest centres in Australia, big knowledge centres, had very, very strong economies as well. So why didn't Brisbane join the party? Their economy didn't recover quick enough after the mining boom. So they, you know, in terms of, broadly speaking, Australia got a cold, but Perth, Darwin and Brisbane ended up getting the flu, right? So certainly, you know, they got the bad flu, Perth and Darwin got the bad. Brisbane got a bad cold, but Melbourne and Sydney pushed through that. So those were the main themes in terms of why we had, and we talked about it before, the rising tide lifting all ships. Right? So we're still in this 30,000 degree view. You get that. Any time, and you can see it as clear as day, you can see it on any graphs that any economists bring out, and that is cost of money goes down, usually property prices go up. When cost of money goes up, property prices usually correct on a macro level. So that has been the combination of our demand story, and we got ourselves into a situation where we were looking at supply. Well, we were looking at debt, and we were looking at all of these other concerns. And so that brings us back into the supply story.
Yeah, well, so how's the correction playing out? Well, in terms of curbing that demand, number one, APRA introduced a speed limit on investment property lending. Yeah. So that was a designed policy by the regulators to create a soft landing. Because to be honest, if we kept on going, it would have been it would have been at levels that you would have experienced a crash.
54% is what we peaked at, Bryce. 54% of all new lending around that 2015 period before APRA intervened with the speed limit was investment lending. Now, historically, longer term, that was sitting at around sort of early 40s, late 30s, early 40s. That's where we need to get back to. Okay, so this is how the regulators and the government, using the terminology, the scalpel approach, as opposed to what they did in New Zealand, which was sort of basically a sledgehammer approach. And you mentioned last week on the podcast about the LVRs. Bang, just hit them with the LVRs. They can't do anything. They can't lend until there's more equity. And it hasn't worked as well as what this has worked.
Well, because it affects other markets, isn't it? Because they were trying to find that delicate balance between handbraking Melbourne and Sydney without, as you say, Perth was already at flu, Darwin is at flu, some of the regionals had a cold, Brisbane had a cold. So how do they get that balance right in terms of taking the heat out of those two markets without just collapsing the other ones that needed an injection of help at the time?
It did. So then they went after the clampdown on interest-only lending. So they saw that as the next risk in the system, because you've got to remember APRA is all about protecting the strength of the financial system. Okay, so their consequence has been, however, that they are now manipulating prices. Okay, so it's been a secondary consequence of them saying we're really worried about, one, the level of activity going on in the investor space. We're really worried about the interest-only story that was growing significantly. And then finally, when they went in and had a look at the lenders, they also said, this idea that you lend based on the assessment rate of the day of another lender, and in other words, you don't put a margin on that or a risk margin on that, all of a sudden meant that they weren't comfortable with that. So they started putting some pressure on the banks to stop lending at the levels that they were lending at, because it could have got worse, much, much worse before it's going to get better.
And that was to also make changes to people taking higher risk lending over 90%. So over 90% you couldn't get interest only lending, but they also changed the pricing too, Ben, didn't they? So investors had a different price point to what the owner occupiers did, again, to artificially say, okay, the owner occupiers is still needed as essential need, but the investors, we need to handbrake you another way.
So they did it to the investors, then they hit it with the owner occupiers to actually encourage them to pay debt down. You know, households during this period have got back to pre-GFC periods where we were at sort of record household level debts, right? Unsustainable over the long term. So we get it. This is, you know, for investing, this is about playing the long game and understanding all of the moving parts. So summarising that, the cost of money goes up. And how do we do that? Well, we do that through charging higher interest rates for investors, charging higher interest rates for interest only, changing the assessment rate. So all that means borrowing power comes down, which, you know, ultimately you are a statistic as a demand statistic if you can actually afford to buy a property. And we've talked about this before. No good in saying I desire to live in a suburb where there's a $5 million property. If you can't afford to borrow or buy that property, you're not a stat, right? So what happens then is, well, I am a stat in the outer suburbs, aren't I, Bryce? Because I can go out and buy out in those suburbs because I can afford it too, and I want to get on this property bandwagon with everybody else. And I want to just enjoy the spoils, because this looks like this thing's never going to end. Always the famous line of any poor investor that think that the road to hallelujah is never going to change for them.
Yeah,
so
we've noticed at the coalface ourselves, Ben, because we're building a lot of plans, more than our fair share across the country, and we're seeing my BA team has largely been buying at a $200,000 price drop for a lot of investors, as opposed to when the APRA put the handbrakes on. So a typical purchase price might now be between sort of 400 and 700, whereas before we had a lot of stuff between 6 and 8. So we've already seen on the coalface that we've had to drop the price point as well as a result, very largely around lending, not so much the cash flow for the client.
Yeah, like, I mean, we know in the property plans that we build, Bryce, in terms of in the past, our numbers were always more conservative than what the lenders would allow to borrow. Now we're on par because we've always had a 200 basis points. We've always done 7.25 long-term interest rate.
No depreciation.
Well, it's all lined up now. So what we're doing in terms of borrowing power is pretty consistent with what the lenders are doing. So that hasn't led to us having to restructure all those plans because we've always been naturally conservative. So this curbing this demand has also meant that, but when you've got a booming market, Bryce, you've got this supply story, right? And you have these new subdivisions and new areas that are exploding and people rolling into those areas, right? But I want to ask you a question, and it's a logical question that everyone should ask themselves. If everything was similar, Bryce, so in other words, if you could buy $1 million property and compare an Apple with $1 million property, say 5 kilometres from Sydney, and $1 million property 35 kilometres from Sydney, what would normally be your choice if they were the same type of configuration, same type of house?
Yeah, close to the action.
Close to the action. Most people want convenience, most people want proximity, and all
with the exception of acreage, but closer to the action.
The amenity is always greater. So there will always be those who buck the trend and want to get away from population. I get that. I understand that. But the vast majority of people want to be humans. They want to be social. They want to be interactive. And that's why the land comes at a premium closer in. So we've got this story where you get this flood of activity and the flood of population and everyone thinking, I've got to get on this bandwagon. And this creates pockets of oversupply. So now what we're seeing is certainly units, and when you also factor in the international buyer, so namely the Chinese buyer, who were flooding into this marketplace in the frenzied period, you were going to always come up short, right? There was always going to be, they got their pre-sales, they're coming out of the ground, so they're going to always overshoot. Because it's human nature, right? You got to make hay while the sun shines. So the developers are working their butts off to get these products built, to get out of the ground, because they're getting a premium for their asset, their premium valuations on their properties, and making a premium return. Knowing that, building cycles, building activity goes in cycles, and some of those valuations may not stack up over the long term. So that's what we saw. In addition to that, we started to see some minor issues in terms of what was coming out.
Well, one was a reduction in foreign demand for what we talked about, in terms of they changed the rules, but also you're seeing a lot of self-managed super fund lending now being pulled out, Ben. So it's taking away that base that's underpinning the supply if they can't get lending within the self-managed super fund space.
So there's a couple of things. So one is obviously the broader lending tightening has done an absolute incredible job of curbing demand, but now we're also starting to see the noise, the media, the regular stories that we're seeing now. I don't think there's a day that goes by where this is not on the mainstream media about property prices, because what is it, Bryce? It's our favourite barbecue topic. It's the number one thing we want to talk about.
And it's probably the biggest risk, isn't it? Because it can become self-fulfilling.
Yeah.
If people do buy into that. And it's interesting because, we talked about the 60 Minutes story about 40%.
Yep.
The question is, does that mean that the 2-bedroom townhouse in Cairns and the 4-bedroom house in Toorak and the 2-bedroom townhouse in Paran and the big 4-bedroom house in, all of those are going to drop 40%? Really?
Yep.
All of them? So, but if people, how often did we have a conversation following that particular story? But then there's been some in follow-up. It's part of the conversation. It's part of what people do. If they act on it, we're probably just lucky that property is not a liquid asset.
Yeah.
Because if it was a liquid asset, we'd be in trouble.
Oh, you named it, Bryce. That you nailed it in terms of that point. Because sentiment is now, the confidence is completely being stripped out. So what are we seeing? We're now seeing the economists also adjusting their numbers down further. So it is very much a self-fulfilling prophecy, a bit like what's going on in the global financial markets in terms and the equity markets. There's concern. We're seeing more risk in there in terms of volatility. So the sentiment is definitely changing volatility, and that is also meaning the markets are a lot more choppier. And as you were saying before, they move in quick numbers. We saw Afterpay drop by as much as 20% in a day. And because it can, right? Because it's liquid. You can't do that in property. So we're seeing this gradual decline. So we're not going to find a bottom for a period of time. Now, that's not to say that there aren't markets that are still growing. There are still literally hundreds, if not thousands, of markets that are still growing across Australia. But broadly speaking, you're going to be reported on the Australian property market is on a downward trend, and it's going to get worse in Melbourne or Sydney.
And the banks are pressure testing their books too, Ben, to make sure that they're not vulnerable. We had Alan Oster on our podcast many podcasts ago, and I remember the conversation we had with him at the time, and we haven't spoken to him for 6 months, but it was like those guys are pressure testing their books a lot, and they don't seem to feel that they're absolutely vulnerable. Clearly they're not ignoring this stuff.
Yeah.
We do have a high equity position in our market in Australia, notwithstanding we've got a fair bit of debt. But you've got the big switch too coming up, which is a big topic that people are talking about right now in terms of coming out of interest-only lending. And I think it's good to shine a bit of light on that, because that can create some fear just through the unknown. Because once you break it down a bit, you don't have to fear it so much.
Correct. There's two things I want to pick up on in terms of the Alan Oster story. So when a bank stress tests its book against its asset base, it's stress testing against several scenarios. So the scenarios that Alan was talking about was assessment rates. Because APRA has put 200 basis points or even more in terms of, so if rates go up 0.5%, the economy could stall, right? So this is the problem that the Reserve Governor and the board face in terms of the influence, just how much a 25 basis points move is actually going to impact the broader economy. So they're not worried about that. They're just sort of saying there is absolutely no stress in people being able to repay. Where the stress lives is in the story around
keeping their job.
Mm-hmm. If we have a deterioration of employment, that could be a contagion in terms of looking at how that affects the marketplace. And I've always said this in terms of most people who are new to property or have bought property in the outer suburbs are young in their careers, right? So I think some of those less educated, less experienced workers are more vulnerable than the workers that might have better job opportunities or can downsize their expectations of their salaries but still find a job, right? Because they've got 10 years or 15 years of experience. New first home buyers are susceptible to that. So circling back to what you were talking about before.
Yeah, in terms of the big switch, Ben, because a lot of people are saying, okay, but if interest-only terms are expiring and they're not going to renew those, doesn't that mean we're in trouble?
Yeah.
It does if you don't have the cash flow, Ben, but that's where the biggest risk is, or if you've bought a property in a high investment cluster. So what do we mean by that? We talk about, obviously, off the plan, greenfields, but if you're in an area where, let's assume that you have bought a property off the plan, Ben, and you're one of 300 people who did that, and you're all of one of 300 people that did it within a 6 to 8 week period, there's a cluster of people that stroll through the market and expired exactly the same, within plus or minus 6 months in that 5 year. Whereas if you've bought the assets that we've talked about throughout this podcast, and say that someone settled today and someone settled next week and someone settled in 6 months, they're rolling through and they're diluted by the fact that they're in a high owner-occupier market that's in high demand.
Yep.
So then you're faced with a choice. One, if you can refinance to get another interest-only period, or you may be in a position where you need to sell because you can no longer get access to that credit. But if you sell, you're in a market that is not being in a huge investment cluster where everyone else in the market is doing the same, because 70% are owner-occupiers, 30% are investors, and there's a staggered approach. So it means that if you can't cash flow it and you do need to put it on the market, you're not as vulnerable as if you are in a greenfield estate or a off the plan.
I think you said it brilliantly, Bryce. I'm calling it concentration risk, right? It's concentration risk of investors. So where there's been a boom of investment buying, those areas are in a lot of trouble, right? In my view, because whether it be like a 4-stage high-rise block and 50% of those people have bought it investments and they've all got 5-year interest-only terms, that is going to be a hotspot in terms of people who may not be able to refinance that.
Because the banks would be unwilling to refinance that en masse.
Correct. And when they did get that funding, there's no doubt that the banks may not have an appetite to re-borrow at that level. So the refinancing option for them is going to be more challenging. New house and land package estates and those types of things are also areas, if there's been a high concentration of people attracted by high yields or negative gearing, or there's been really good marketers who have sold a lot of concentration of investment stock in those areas, you are also under risk of coming out at the same time as everyone else. Because what happens in those markets, Bryce, is, if I've gone and built 15 townhouses, or I've gone and built 250 apartments, the certificate of occupancy is usually issued at exactly the same time.
Correct. And then the banks start scrambling to settle.
You've got 14 to 21 days to settle. So we do know that there is concentration risk. But what you were saying beautifully before is when you buy random one-offs in different areas of established property, and all with different buyers in different sort of circumstances, you don't have that risk. So when I panic when I hear some so-called great commentators talk about, I love this area, it's got 60% investors, right? That means I've got a good concentration of renters to rent my property. I'm thinking, you will never get long-term capital growth, my friend. You have completely missed the whole story in terms of understanding where long-term property growth comes from. So they're big ones.
Now the other one, Ben, is a mining town. So clearly there's been a documented case of people who lost money, but if they chose to sit out for long term, and they may be
negative equity already. So big negative equity already.
And then they can't refinance, and then they put it on the market, they could be well and truly exposed.
They're the really danger signs. That's the fact. That's the story of the house of cards falling in on that particular investor. So nothing worse than paying $400,000 in Moranbah as an example. That property's now worth $150,000. You're thinking back going, well, it's all right, I can service it. All right, so I'm paying me interest only. But then it comes out and the bank says, well, you've got 7 or 8 properties here now. That one's in negative, that one's in negative. And you may not have enough to cover it, and you certainly can't get any more funding. So you've got to liquidate.
Loss becomes a real loss.
Oh yeah. So that then ripples. So make no mistake. Winter is coming. People are going to get burnt, and we said that, and we've been saying this for a long, long period of time. That's why our flight to quality has always been about playing the long game. But we'll finish off with that later.
Yeah, well, so here's a couple of headwinds to think about, Ben. Obviously, one is potential changes to negative gearing capital gains tax. 2 is you've talked about jobs and unemployment. 3 is any impacts yet to be determined of the Banking Royal Commission. And 4, whether or not people get access to using mortgage brokers, because there's talk around whether or not that will be sent back to the banks.
So people might be sitting there going, holy crap, this is a perfect storm. We haven't seen this in the property market for a long time, So the reality is, in terms of negative gearing and capital gains tax exemptions, is that would be the stupidest thing you could ever do if you have any understanding of economic management and jobs growth, because you've got to remember the correlation between residential property, retail jobs, construction jobs, services jobs, it flows on, right? In terms of what's available, feeding migration, the abandonment of the rental accommodation that governments are also supplying. It would be the stupidest thing to do unless you want a recession. Unless you want to break our 28 years of positive economic growth, if you want to be the treasurer or you want to be the government who stuffs it up, that would be the perfect recipe to be able to bring those property prices down even further.
If you want to be I cannot get Paul Keating out of my mind. When I was growing up at that impressionable age, he said this is the recession we had to have. If you want to be that person of this generation.
Oh, no, he was good. That was a good recession. That was about inflation going out of control.
But that's all I remember. That's all I remember. No. But the thing is, he
restructured the economy.
He's done an amazing.
This is crazy stuff.
He's got a great legacy for that. But the thing is, I put in the Money magazine that I always felt that residential property was underpinned by the ballot box. Because the government at the time was always going to do whatever it can to protect the underlying value of your home. Sadly, that policy seems to undermine that it's underpinned at the ballot box.
Well, what is the current investor learning right now? The one who's ill-informed and ill-educated. Off the plan is a nightmare. You lose money. House and land packages, very questionable about growth and making money. You might get some yield and depreciation, some tax benefits, but that's just stupid. You're not an investor if you're after that. So if they're learning that, well, negative gearing exacerbates that. The government of the Labor Party are going to be sitting there going, but but this is about creating jobs, People they're not looking at the secondary market. And we keep saying to them, you have no idea. People now understand there's going to be a flood of properties already on the market because there's going to be people who won't be able to afford that poorly located properties in these what were once booming suburbs. We only need to look at the Gold Coast as a perfect example of a booming town and a booming market through the 80s and early, and then
ghost town.
Crickets,
Is that your cricket voice?
No income, no income. Can we put a sound thing over that, Iris, with crickets? There's what happened? No thought leader jobs, no big higher income jobs, no economy, right? People necessarily, and once you go on the Gold Coast a couple of times for tourism, you might want to look for something else, right? Change the scenery. So this is the point that we make around that. Now,
because it's popular to blame negative gearing as the reason for price affordability, but there's the supply stuff we talked about, high population, a trend down to lower interest rates. There's so much more than negative gearing, and as we talked about all the time, negative gearing is a tax outcome, not a strategy, because ultimately the goal of every person negative gearing who's doing it properly, in my view,
not speculating, investing,
is to get it to neutral gearing as soon as possible so that they can move into positive cash flow even faster, so that they can actually self-fund a retirement. The goal is not to stay a negative gearer forever.
And that's the income that they're going to live off, Bryce. So it makes no sense. Furthermore, you've got a slowing economy, and we've just demonstrated, like the regulators have demonstrated how you can manipulate the market to take out the demand, right? Labor was saying in the heavy days of high unaffordability and so forth, well, this is the only way it can work. There's no other way in which you can get negative, no other way you can get property prices down. Because that's what we're talking about here, where it's not, and that's silly. You actually want property prices to go up. There's so many other consequences around household spending and confidence, the wealth effect and so forth. So you stop that, then you bring a job story in here, which is problematic in itself. All that construction stuff's gone. So is the mining boom going to kick back in and they all go back to those trades? Maybe not. We definitely know that there's an agenda of infrastructure, but that's not going to create hundreds of thousands of jobs that are being created in trades and services and retail at the moment. So it would be the stupidest thing of any government to look at negative gearing at the moment and say, this is a smart idea. The same thing with capital gains exemptions, right? The only people that will be selling their properties are the people who haven't made any money. They get a capital loss that they can write off against their
forward,
property. Yeah, because they haven't bought well. The great buyers, the great property investors buy well. They test the marketplace out. They understand its owner-occupier. They understand its livability. They do all of the sort of decision tests that we talk about in terms of finding the 70% of people who want to live there and why it's attractive to live there, and the money starts to flow into those locations. So that is an important story.
So Ben, so we want to pivot to prevention.
Yes.
We want to pivot to what could possible solutions be to make sure, because you opened the batting with saying, are we in a bubble or are we in a balloon? So it's probably worth, I know what you mean, but just for clarity, the bubble you're talking about, the pinprick and it explodes, versus if you remember your kid's birthday party, you go and blow up the balloon and you're like, just leave a little bit of air out of it.
Maybe another sound effect for that one as well.
Wow, I thought that was better than his. But in terms of just letting some air out and the balloon doesn't pop.
Yeah, and that's what we're talking about. In my time and in terms of the data that I've looked at, the only time you could probably argue that there was a property bubble or the property market values bursting was the Great Depression, okay? And that was all about the jobs, right? People just couldn't find work, and there was no stimulus in terms of what happened like we've seen post-GFC. So in terms of price reductions, depending on which data you're looking at, people say it was between 20 and 30, if not 40% in some areas, and it could have been. And even in this market correction, we're going to see some areas go down by 40%. So if we understand that you don't have property bubbles bursting, right, because of the illiquidity of the property, right? It takes time to sell it, so there's no panic selling. But what you do get is these corrections where they deflate, okay? And in this particular case, this balloon was blowing up too quickly. It wasn't blown up through the fundamentals of the right people buying the right properties. I've always said, I want a property market where 30% investors, 70% owner-occupiers. I don't want a property market. It's not for everyone. The people who listen to this podcast, keep it a secret, right? There's only a few of us are going to be able to do this, because the reality is we can't all be property investors, right? We just simply can't. Those people who want to make a difference to their household, that 30% of the population who want to self-fund their retirement, that's who I'm talking to here. All of the other people, go and invest in shares, do whatever you need to do to get your financial future secure. But it's unsustainable at the level we're getting at, and that's what's been happening. So what is the prevention things? So I've got a couple here. Do you want to share one as well?
Well, we've got three really that we want to talk about. One is the monetary policy, and one is to sit tight on the interest rate, or at some point even drop it.
Cool.
So that, and that's a story around stimulating jobs really, because you want to be still encouraging business to be investing in growth, so that they're still investing in jobs.
Correct. It's a mandate, right? So the mandate here is we might see a little bit of inflation come through the system, because inflation's been dead, right? We haven't had inflation. We don't have full employment, even though our unemployment rate has gone down. We've got underemployment in some areas of the market. So the Reserve Bank, they're clever people, right? They get this, and that's why they haven't been moving the rate. And the last thing they want to do in terms of a drop is to get the property market firing up again. Yeah. But I think what they've seen through this manipulation that's been happening is
they've got the sentiment shift right.
Yeah, I reckon that they could feel that there could be, Governor Lowe could feel that, you know, in 6 or 12 months' time, if the story is still getting a little bit more concerning, that they could pull the lever on just reducing that, so we get that consumer spending and that household spending back into an area. So they have that lever. It's not a big one to pull because of the cost of money that's being passed on to us as lenders right now. That's a big one. The other big thing is wage growth, right? We're not seeing wage growth. And this is globally happening, Bryce. Like, you know, this is something that the economists and all of the smart people in the world are trying to identify why it is that we're not seeing broad wage growth when we're seeing strong economic activity. And the US is happening as well. So it comes down to a few things, and they are things like automation, right? So machines, robots, doing those types of job. Globalization in the sense that we're now outsourcing to lower cost labour, right? So I do feel that, you know, and this is what makes me sleep really easy at night, because people will be listening to this podcast going, holy crap, why are we getting into property? This thing's not going to go anywhere. And my view here is, and I'll come back to this in a little bit more detail, but I want to be in marketplaces where there is thought leadership and experienced, qualified people who do work. So the demographics that I'm looking for are people who do work that's going to be work of the future, not basic work or work of the past century, right? Because they are the ones who are going to get that exponential income growth, and that's what's going to push the prices up. So I want to circle back to that.
Yeah, because we've talked about the rising tide not lifting all ships anymore, so you have to be very smart about which suburbs you choose, because organic growth in household cash flow is gone.
There is a tipping point here, right? And this is what we were saying before. Where does property value start? It starts from the centre and moves out, right? And it would be an impossible scenario for me to try and argue and prosecute that property prices in the outer suburbs are going to grow in higher value than property prices closer in. It just cannot happen.
It fails economic activity, human interest,
and human behaviour. All the things that we've been looking at. So the monetary policy story is an interesting one. They've still got a little bit left in the tank if they need to do that. But inflation, I was saying that before, inflation could flow through in terms of oil prices. We're certainly seeing iron ore prices have also gone up. So, you know, the raw materials have gone up in cost. We've got obviously a drought at the moment. So in some cases that's good for our primary meats and so forth, because most farmers release their animals for slaughter because they can't feed them. But then they've got to restock. Okay, so that means that after this sort of drought period breaks, they then are buying the animals, so there's less meat coming through, so that means cost of meat, supply and demand. It's a classic case of supply and demand. And the final one is...
Well, the thing is, we're not as well prepared as we were during the GFC either, Ben, are we? Because we had $21 trillion worth of surplus funds as a government, which meant that some of these areas where we've talked about that are in trouble, they were a little bit more insulated because the government was firing a heap of cash to stimulate the economy. Well, really, they've only got interest rates to play with now because we're in deficit.
Correct. And the Aussie dollar has gone down, right? So we import a lot of electrical goods. So those electrical goods are going to cost us more. Okay, so all of a sudden there is some element of inflation that could start creeping into our numbers. So we just got to be mindful of that. And I'm sure the Reserve Board, they're sort of saying, well, part of that could be that, with the trade wars going on over in the US versus China, they might dump a lot of their electrical and clothing and all that down in our market, right? So they might be the ones who get caught out here because they've got an oversupply and if their domestic consumption isn't going to pick up that, they might dump that stock down here. So we may not see that inflation move through because we're paying more for that to import those materials considering the Aussie dollar is lower.
So that's one for prevention is around monetary policy. Number two is the Labor Party dropping their proposed negative gearing changes and CGT changes.
Yeah, well, I just think that there needs to be sensible heads in the room around this idea that it is by nature going to drop demand. Okay, so and as I circled back before, the lessons learnt from this boom bust period is going to be don't buy new because it doesn't work, right? I think that's going to be a big story here. So if the Labor policy is arguing that their policy is all about great incentives for new construction and you get negative gearing on new property, the secondary market story for them is just not going to work. Okay, so we've laboured on that point, so I don't want to keep going on it, but it's just not a good thing to take more demand out because you're affecting owner-occupiers just as much as you're affecting investors in terms of price.
But Ben, the big one, the third one is the hands of the regulators to release the handbrake if they so choose to.
Yeah, I think this is the one where if again smarter heads prevail, there was absolutely some risk going into the system when APRA stepped in seriously in 2015-16. That risk is now dissipating in the system, right? Prior to that, it was just foreseen risk. There was no evidence, all right? So there was no evidence of risk in terms of delinquencies, mortgagee and possession sales. None of that was happening. So it was all preventative as opposed to recovering from that position. So the story goes, if you ask any senior banker, they'll tell you that traditionally owner-occupiers are worse at mortgage delinquency than what investors are. Okay, so we've got this story now where if the regulators, and this is not only APRA but also ASIC around responsible lending, because what ASIC are doing around responsible lending is they are scrutinising expenditure heavier than they ever have before. And that would mean that, I just saw an article just today about Uber Eats. Don't use Uber Eats.
Yeah, I saw that
because if you use Uber Eats, then the banks are going to look at you as someone who discretionarily spends.
Yep.
I mean, it's going from silly to ridiculous.
It's all right, Uber Eats stopped delivering grilled, so I won't use it anymore.
There's a little message to Uber Eats and grilled. So that's a challenge for us, right? So we need them to start looking at policy, given that the system is pretty solid now, to start to releasing a little bit of that, especially for this refinance market that's coming through, because that could create further downside risk in regards to the demand side of the story.
So there you go, folks. In terms of whether it's a balloon or a bubble, we've talked about how did the last boom materialise, how it is that the correction played out both on the demand side and the supply side. We talked about the big switch, Ben, the interest-only switch. We've talked about minor issues. We talk about headwinds. We've just talked about a solution. So here's some key takeaways, and you throw in as well, Ben. But
sure.
Number one, key takeaway, if you've bought into heavy investor stock, you'll very much potentially be vulnerable in a lot of spaces, but particularly
the show's not over there.
During the big switch. Number two, there is a risk of contagion risk if people's confidence flows into sentiment and it becomes a self-fulfilling prophecy. Number three is consider being borderless, Ben, if you are going to continue to invest in a market that's showing good for buyers, because obviously we've talked a lot about what they're doing for Melbourne and Sydney, but the other markets haven't gone as high as Melbourne and Sydney through the last boom. Four, you need to be, during winter, you need to be more focused on cash flow than you need to be on balance sheet, because the value of your properties will fluctuate without a doubt, but that doesn't determine whether or not you can hold it or not. So determining whether you've got the cash flow, and we've always talked, you buy the right property, you hold it for the long term, you correctly finance, and you buy when your cash flow allows. So it's important to understand that your cash flow is more important than ever right now. And number five, Ben, is general commentary is what is reported, but general commentary helps no one because you are not buying Melbourne, you are not buying Sydney. We've said this enough, but it's important to understand you are going to get headline shocks still for the next foreseeable future from people that are writing about the market. But remember, it's hundreds and hundreds and hundreds of submarkets, and so you just got to determine, have you bought in an area that's dominated by investors or owner-occupiers? Have you got scarcity? Have you got owner-occupier appeal? Have you bought in investment grade quality? Have you bought around the population centres that aren't vulnerable for employment? If that's the case, it's business as usual as long as your cash flow allows.
And for me, it's go back to fundamentals, demand and supply. And where I want to buy, where the land value is at its most premium, because the story of the land value comes back to the story of the people who live in that area. So I want to find areas where I have high income, which is usually growing above trend income, okay? And in some cases, I want to be an area with like-minded people, okay? So where you've got professional, educated people, there is aspirations for other families and people to move into that area. So I like the idea that I've got strong income growth, and I like the idea that I've got a fully utilised market. So in other words, the supply side is constrained. And as opportunities for entrepreneurs and for people who break through the window of where they're going in terms of their careers and get to that next level of management and take on that bigger, win that bigger wage story, they're going to uproot and they're going to go into these locations, all right? And remember, property prices cannot move. They cannot move unless borrowers can afford to buy at that price point, all right? So that's why when you've got tight demand and strong supply, they are the areas over the long term, 20, 30, 40 years, that in my view outperform in terms of giving you the ultimate returns, which is capital growth in the hundreds of thousands, if not millions of dollars, and the income that you live passively off as a smart investor. So really sensible stuff.
Very good, Ben. I think that's best summarised by saying buy where the people are in control of their income next year, whether they're because of a sales increase in commission because they've got an extra dividend, versus someone who has to go and pick it with 50,000 other people down the CBD in the hope to get a 2 or a 3% pay rise, Ben. They're vulnerable, whereas the people who are in control of their income, because if they get more income, they've got more borrowing capacity, they can buy more, they can buy push prices.
Because those ones in the outer suburbs, Bryce, who just, honey, I just got home and I've just got a state gig, or I've got a regional gig, and it's just put an extra $60,000 of income into my pocket. Right, well, we're getting out of here. Do you know what I mean? Like, we want to uplift and we'll sell up here and we'll go and move closer. That's usually the story. But the people who are also generationally entwined into those more established areas raise their children on the expectations of good quality jobs in changing worlds, and they're going to get strong incomes as well. So that's the combination, the winning combination that puts demand into those centres. I saw last night, caught Alan Kohler's ABC News presentation. G'day, Alan, if you're listening. And he was talking. He showed a graph of the Sydney property market and it turning down, and then Wentworth. In terms of the seat, and it's actually still going up. So that's a good story of flight to quality, and we keep talking about that in terms of, so for the astute investor, what does this mean? As my final takeaway, astute investor, opportunity knocks. That's all we'll say. Opportunity knocks. These are the times where you can make some of your smartest moves in terms of getting into some of these better marketplaces.
Well said. Hey folks, Ben does an announcement every month. What we've decided to do is a new feature on the podcast. So we're going to strip the audio out of that, Ben.
Rightio.
And we are going to put it as a bonus episode for the Property Couch listeners. So you'll be able to hear that. But I think people for the last hour or so, Ivis, did we tick over an hour?
What was an important episode?
Front row seat. Ben thinks about this a lot, folks. You would have seen that from what you've just heard. I think that was a really good summary, and I think it just gives people a timely message about this too shall pass as long as you are prepared correctly.
Yep.
And there are some vulnerabilities.
And seek advice if you don't know what you're doing. Right? There's big money at stake here.
All right. Very good, Ben. Let us know what you think, folks. Reach out to us at info@thepropertycouch.com.au if that resonated too. Hey, Ben, my life hack today. I'm just going to lift the spirits on this one. This is from Ben.
Okay,
not you.
I know. I like him already.
Ben, he's a 33-year-old project manager engineer from Adelaide. When doing your washing, Ben, this is a good tip for you.
Oh,
because I know you do this a lot.
Yes.
Peg the sock pairs together on the line, and then bunch them together by wrapping one over the other. Saves one peg and no more odd socks.
I definitely do pair them together.
Yep.
When I hang them up. So thank you, Ben.
When you hang them up, how often is that?
All the time. All the time. Yeah. Well, when I'm home, that's not all the time. but yeah, no, I definitely. Yeah, I do try and pair them up, and then you pull them, bang, and done.
I got to be
no
honest.
double handling.
I got to be honest, Ben. I have to listen to this Ben a bit more because we've got one of those dryers that can. You've got a condenser, so when it goes through the dryer, you can tip the water out so it doesn't create. So probably a little bit on the lazy side with the socks in our house. And then I wonder why I've got so many odd socks. So
there you go,
Ben. Very good, Ben. Keep sending me in, folks. Did you know?
Well, because we're tight on time.
Yep.
Quick one.
Oh.
And you know, for all of those politicians out there, I don't like you. 125. What's that number mean, Bryce? 125.
How many times Collingwood's made it to the grand final hasn't won?
No, that would be that could be right.
Yeah.
That's the number of different types of taxes levelled in Australia.
Is that levied?
Levied. Oh, God. Levelled. Levied in Australia. 125 taxes.
Yeah.
My God, I'm tired now.
Mate, I'm
going to go and have some lunch.
That's okay. That's what it's like being on the, at the end of a big session like that.
And now I've got to go and do some recordings for some. Anyway.
Yeah.
There you go.
125, Ben.
125. The number of different types of taxes levied in Australia. Too many.
Drop them off.
Too many.
Way too many. So very, very good. So hopefully that was helpful to you, folks. Whether we are in a bubble or a balloon, hopefully that's helped settle the score. But Ben, until next week.
Knowledge is empowering, Bryce, but only if you act on it. And the time is pretty now to get going. Go and get it.
Nice little foot though. You're not going to sign off in French either, right? All right, folks. We'll see you next week.